Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of company filing so you don't have to. And today we are looking at the Federal Home Loan Bank of Atlanta. And let me tell you, this filing we have here is going to give us a peek behind the curtain of how they handle their funding through something called consolidated obligations. Make sure you stick around to see what new debt this bank is taking on. Before we dive in, if you enjoy getting clean and simple insights from dense corporate documents, make sure you are subscribed, and for more real-time discussions and dives, join our Discord community. The link is in the description below. So, what is the big news here? Essentially, the Federal Home Loan Bank of Atlanta, or the bank as we'll call it, is reporting on some of its financial obligations. Most of the money this bank uses comes from selling debt. Think of it like issuing bonds, but for banks. These are called consolidated obligations, and they are a big deal because they are actually the responsibility of all 11 federal home loan banks working together. It is like a big financial safety net. Now this is where it gets interesting. The filing points us to a table, Schedule A, which lists the consolidated obligation bonds and discount notes that the bank is committed to issue. This schedule is pretty important because it shows us the new debt the bank is taking on. You can see here the trade date, which is when they agreed to issue the debt, and then the settlement date when the actual exchange happens, and of course the maturity date when they have to pay it all back. You'll notice a few key numbers here. We're looking at one specific offering for about $15 million. It has a coupon rate of 4.03%. This means that for every $100 borrowed, the bank will pay out about $4.03 in interest each year. This particular bond is set to mature in November of 2027, meaning it is a medium-term debt. It also has what is called an optional principal redemption, which means the bank can choose to pay it back earlier than the maturity date if they decide it is a good idea. The style of this redemption is Bermudan, which means they can pay it back on specific, recurring dates once a certain period passes. The rate type is listed as fixed constant. This is pretty straightforward. It means the interest rate, that 4.03%, will not change over the life of this bond. It is a predictable cost for the bank, and for the investors, they know exactly what return they will get. This specific entry here under bank par is the principal amount, so $15 million is $15 million. This is the core amount the bank is borrowing and will need to repay. It is important to remember that this report is just a snapshot of new debt being issued. It doesn't show all the debt the bank might have outstanding, and it also excludes very short term debt, which is pretty common for a bank to manage its daily cash flow. Now let's talk about this optional principal redemption. Think of it as an early exit option for the bank. If market conditions change, or if the bank's financial situation improves, they might want to pay back this debt sooner to save on future interest payments. This gives them flexibility, which is always valuable in finance. The filing gives us good details on the types of rates. So when it says fixed constant, it tells us that the interest payments are locked in. They will not go up or down based on market fluctuations. This is different from variable rate debt where the interest can change over time. For these consolidated obligations, the bank is locking in a specific borrowing cost for a set period. And just like any official report, it is signed off at the end. This one has a signature from Lee Boosby, who holds the title of Senior Capital Markets Trader. This tells us that this filing is very much about the day-to-day operations of how the bank manages its borrowing in the financial markets. The date on the signature is the 6th of November, 2025, which is just a few days after the trade date on Schedule A, showing a pretty quick turnaround. So, what does this all mean for the Federal Home Loan Bank of Atlanta and for us watching? Well, this filing isn't about exciting new product launches or major strategic shifts. It is about the fundamental plumbing of a financial institution. How it gets its money. The bank is issuing new debt, $15 million worth, at a 4.03% fixed rate. This is a common and necessary activity for a bank like this. It allows them to fund their operations and continue to provide services likely to other financial institutions. On the positive side, the bank is actively managing its debt by potentially having redemption options, and the fixed rate provides certainty. On the other hand, like any debt issuance, it adds to the bank's overall liabilities. We need to remember that these consolidated obligations are the joint and several responsibility of all 11 federal home loan banks. So, while this specific filing is about Atlanta, it's part of a larger system-wide financial structure. We certainly didn't see any red flags or massive unexpected debt in this particular report, but it is always good to keep an eye on how these institutions manage their leverage. Alright, that is our breakdown of this Federal Home Loan Bank of Atlanta filing. What is your take on how banks fund themselves and what this kind of debt issuance signals for them? Drop your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into corporate finances. And don't forget to join our Discord community linked in the description for more engaging conversations. Thanks for watching. See you next time.